The first type of company we're going to look at is a private company, which is proprietary limited. So maybe go and watch, we did a video just earlier about what is a company and how public and private company are different. So here we're just going to summarize with this one. What is a private company? So let's start with a definition. The definition is, it is an incorporated business or a corporation, which is a separate legal entity to its owners or shareholders, and it is not listed on the Australian Securities Exchange or the Stock Exchange. Now, the number of owners can be 1 to 50, called shareholders, and that means that shares are not on the stock exchange. However, it is a separate legal entity to the owners. Okay, so it's going to have that limited liability down here, but 1 to 50 owners called shareholders. Some of the textbooks say 2 to 50. I think some of my slides might say 2 to 50, but yeah, 1 to 50, 2 to 50, around there. Management and risk profile. So the important thing is that it's a maximum of 50. Management and risk profile. The management of the business is delegated to a board of directors. What does that mean? We've got an earlier video where we said if you are a shareholder in a company, you most likely don't work at the business, unlike a sole trader where you probably do work at the business. So here you delegate that responsibility for managing the business to what's called a board of directors. And your financial risk is based on the percentage that you own. So if you own 10%, you share 10% of the risk. If you own 60%, you share 60% of the risk, and so on. And therefore, the profits are also, or the dividends we call them, are distributed the same way based on your percentage of ownership. It has limited liability because it is a separate legal entity, and it has perpetuity. So if you sell your shares in a private company, you need to get the approval of other shareholders, but the business itself continues to exist. It's just the owners who change. Some pros and cons of this type of business. Well, first big advantage is we've got that limited liability. The business is a separate legal entity, so owners' potential losses are limited to only what they invested. They can't come and take your personal assets. Secondly, we've got access to extra capital or finance by issuing more shares. We can issue shares up to 50 people. So therefore, that's a good way to get more finance for the business. The business has perpetuity. If an ownership change happens, a new business does not need to be formed. And lastly, because the owners don't manage the business, well, it's not relying on the expert. You might have a lot of money, but not be a good manager. Well, this is a great type of business for you. You can go and hire the best directors and managers to run the business on your behalf. There are some disadvantages though. There's a high degree of complexity in establishing. You're going to need a lot of lawyers and accountants to create a company compared to, say, a sole trader or a partnership. You also got limited access to funds when you think about it. If you can only get 50 shareholders, well, that's only 50 sources of finance before you might need to borrow from the bank. So it's a little bit limited. It's also really difficult for owners to sell their shares. It's a bit like selling a car. You can't sell them on the stock exchange. You've got to privately sell them, go and find a buyer yourself. And you've also got to get permission of the other shareholders. So that's a little bit cumbersome, and you don't want that necessarily. There's high government regulation. You've got to lodge a lot of financial information and results with the government. So register as shareholders, what happens at directors' meetings, and so on. You've got to tell the government that. And lastly, there's a lot of profit pressure. Because the shareholders and managers may be different people, the managers are often under pressure to maximize the profits or dividends for shareholders every year. If you don't work there, you don't sort of know the ins and outs of why the business did well or didn't do well. All you care about as a shareholder is profit. I want my dividends to be increased. So when you think about it, that creates a lot of pressure on the people running the business to always maximize profits, which when we look at ethics and social responsibility, can lead to shortcuts and a lot of bad behavior.